You know that feeling.
Yeah.
You open your refrigerator door, the little light clicks on, and you reach for a carton of milk. Or maybe it's a bottle of juice.
Right, the most routine thing in the world.
Exactly. In that specific moment, your brain processes this as just the simplest interaction. You pour a glass, you drink it, you put it back. The entire transaction feels incredibly localized. You know, a cow somewhere, a farm, a cardboard box, your fridge.
Yeah, but the modern consumer experience is specifically designed to maintain that illusion of simplicity. I mean, you are never really supposed to see the machinery operating behind that glass of milk.
But the moment you actually peel back the label and step into the reality of modern globalized food production, that illusion completely shatters. I mean, that simple carton of milk is the final output of an international logistics matrix that is, honestly, it's mind-boggling. Welcome to this deep dive. I'm Hassan.
And I'm Zainab.
And we are jumping straight into the engine room of the Middle East's largest food and beverage company. Our source material today is Almarai's 2025 annual report.
Yeah.
But we aren't here to just, read a list of the products they sell. We are putting their entire business model under a microscope.
We really are. We're scrutinizing their financial performance matrix. We're putting their 2025 margins, their return on equity, and their core profitability head-to-head with their 2024 numbers.
Right. Our mission today is to figure out if their philosophy of absolute end-to-end control actually translates into true financial health. Because, being massive, that's a vanity metric.
Exactly. Generating resilient compound profit in a global economy that is dealing with rampant commodity inflation and geopolitical supply chain fractures, that is the actual test of a business model.
To give you a sense of the scale we are dealing with here before we even touch a spreadsheet, imagine a company that grows its own specific blend of cow feed on private arable farms thousands of miles away in Argentina.
Thousands of miles.
Yeah, they ship it across the ocean, feed it to one of the largest dairy herds on the planet, and then manage the final delivery down to the minute using artificial intelligence.
It's wild. It operates less like a traditional food brand and more like a completely self-sustaining biosphere.
Okay, let's unpack this.
Yeah.
I love that biosphere concept because when I was reading through the operational footprint in this report, I was struck by how entirely out of step it is with modern corporate trends.
Oh, absolutely. It defies the current playbook.
Right. If you look at the last decade of business strategy, the holy grail for almost every major company has been the asset-light model. Tech companies, clothing brands, even other food conglomerates, they want to own the brand IP and just outsource literally everything else.
Yeah, they don't want to own factories. They definitely don't want to own farms.
They hire third-party logistics firms to move their stuff. They want a clean balance sheet.
But that asset-light philosophy assumes a perfectly stable world, It assumes global supply chains will always function smoothly. It assumes you can always find a contractor to build your product and a shipping lane open to move it.
But Almarai rejects that entirely. They manage what the report calls biological foundations. We are talking about 8 massive, highly engineered dairy farms housing over 189,000 cows in Saudi Arabia.
And to feed those cows, they don't just buy grain on the open market. They operate 27 of their own arable farms across the United States and Argentina.
Wait, 27 farms?
Yes. Those farms produced over 257,000 metric tons of feed in 2025 alone. They literally control the seed in the South American soil just to guarantee the nutritional profile of the milk in the Middle East.
That is insane control. And then that raw material moves through 34 of their own production facilities. It is ultimately delivered to 129 sales depots by a proprietary fleet of over 12,000 vehicles.
3,000.
And tying this entire physical leviathan together is a digital nervous system. The report highlights a massive upgrade they deployed this year to a cloud architecture called SAP S/4HANA.
Which is critical. That digital infrastructure upgrade is what actually makes the biosphere work. We aren't just talking about, a glorified spreadsheet tracking inventory here.
No, not at all.
A system like S/4HANA allows a company to run predictive logistics. If a truck breaks down on a highway in August, the digital core instantly recalculates the temperature degradation of the milk, reroutes a backup vehicle, and alerts the receiving depot without a human dispatcher ever needing to untangle the mess.
Oh, wow. But look at this from the perspective of an investor. Owning 12,000 heavy vehicles, operating dozens of mega farms, managing the health of nearly 200,000 animals, and building your own software backbone, and the capital required to maintain that is astronomical.
It is a massive capital burden.
Why take all that risk onto your own balance sheet? If a third-party trucking company goes bankrupt, You just hire a new one. If your own fleet of 12,000 trucks needs sudden maintenance or fuel prices spike, you absorb that entire financial blow.
Well, you have to consider the geographical and economic reality of the region. The Middle East structurally relies on imports for a vast majority of its basic food security. When your core promise to the consumer is quality you can trust, outsourcing your operations in an import-heavy environment is actually the ultimate risk. If global shipping lanes freeze, which, we have seen happen recently, or a contractor cuts corners on refrigeration, the asset-light company suddenly has empty supermarket shelves.
Or spoiled products.
Exactly.
Hmm.
Almarai absorbs that massive upfront capital intensity specifically to buy operational resilience.
So they're essentially building an economic fortress. They don't have to cross their fingers and hope a supplier meets their hygiene standards. They dictate and enforce the standards themselves, from the dirt to the shelf.
The trade-off is fundamental to their DNA. They spend billions to build the fortress, but once inside, they're insulated from the supply chain volatility that routinely destroys their competitors.
Okay, so the theoretical foundation makes sense. Building a biosphere protects you from the chaos outside. But let's subject that theory to the actual math.
Let's do it.
The most pressing question for anyone analyzing this company is whether that massive capital burden actually yields a proportional financial return. Let's open up the scorecard and compare the 2025 performance matrix directly against 2024.
The top-line revenue is definitely the best place to start. In 2025, total sales crossed just over 22.065 billion reals.
Which represents a 5% increase from the roughly 20.98 billion they brought in during 2024.
Right. And a 5% jump in a mature food market is a very solid, steady bump. It was driven mostly by volume growth in their core categories.
Meaning people are actually buying more products, not just paying inflated prices for the same amount of stuff.
Exactly. But the number that requires real scrutiny is the bottom line. Net profit hit 2.456 billion reals, up 6% from 2.313 billion in 2024.
Wait, so profit is growing faster than revenue?
It is. And when net profit grows at a faster rate than top-line revenue, it signals that the operational engine is becoming increasingly efficient. They aren't just selling more, they are making more money on each individual item they sell.
The margin percentages tell us exactly how they pulled that off. They stabilized their gross margin at a very healthy 31%, and their operating margin hit 14%.
What's fascinating here is how they maintain those margins, because we really have to contextualize those numbers against the economic environment of 2025. This was not a calm year for global logistics.
Definitely not. The headwinds were severe.
They faced a global surge in the price of raw dairy commodities. Simultaneously, they absorbed significant structural cost increases domestically, specifically a massive spike in diesel prices.
And when your distribution model relies on fueling 12,000 heavy commercial vehicles every single day, a spike in diesel is a direct, unavoidable hit to your overhead.
Unavoidable.
That is the exact vulnerability I was talking about earlier. So how does a company maintain a 31% gross margin when the raw milk components are surging in price globally and the fuel to deliver their products is skyrocketing locally?
Well, the lazy corporate maneuver is to simply hike prices and force the consumer to absorb all the inflation.
Which obviously damages brand loyalty.
Exactly. Instead, they utilize the sheer scale of the biosphere we discussed. Because they control the entire value chain, they possess multiple levers to offset inflation. They aggressively utilized hedging strategies on the procurement side.
Okay, let's break down hedging for the listener, because it's one of those terms thrown around in finance that sounds opaque, but is actually pretty straightforward.
It's basically an insurance policy.
Right. Hedging is essentially buying an insurance policy against future price spikes. It's like locking in the price of fuel for your car for the next 2 years. Even if the price of gas doubles at the pump tomorrow, you still pay the lower locked-in rate.
Yep, and by locking in lower costs for certain agricultural inputs globally, they neutralized the sting of the dairy commodity spikes. Furthermore, they launched internal optimization protocols to increase distribution productivity.
So they figured out how to pack trucks more efficiently and route them faster.
Precisely. They absorbed the economic shock by making their internal network tighter, preserving that 31% gross margin without entirely burdening the consumer.
Okay, so the biosphere generates revenue, it grows profit faster than sales, and it defends its margins against inflation. It looks impeccable on the surface. But when I dug deeper into the return metrics, specifically how efficiently they're utilizing this massive asset base to generate those profits, I found a potential crack in the fortress.
The return metrics often tell a completely different story than the gross profit.
Exactly what I found. I looked at the return on net operating assets, or NOA. It actually dropped. It fell to 9.7% in 2025, down from 10.3% in 2024.
Okay, slight dip.
But even more surprisingly, their operating cash flow evaporated by over half a billion rials. They went from 6.028 billion down to 5.463 billion rials. If the engine is running so efficiently, why is the return on their assets shrinking? And where did half a billion rials of operating cash flow vanish to? Is this a red flag?
If you evaluate it in a strict 12-month vacuum, dropping returns and shrinking cash flow absolutely trigger alarm bells. But if we connect this to the bigger picture and look at the company's life cycle, Almarai is executing a massive value harvesting phase.
Value harvesting phase.
Yes, they are in the middle of a notoriously heavy capital investment cycle. They're intentionally spending heavily right now.
Meaning they're aggressively buying new, expensive components for the Biosphere, which completely alters the math on the return metrics.
Right, because if return on assets is a fraction profits divided by total assets, and you suddenly buy a billion rial factory.
The bottom half of that fraction inflates massively. The percentage drops temporarily until that new factory actually starts pumping out products.
That denominator effect is precisely what is happening. Their capital expenditure jumped from 3.634 billion rials in 2024 to 4.385 billion in 2025. You cannot deploy an additional 750 million rials into hard infrastructure without a temporary hit to your immediate cash flow and your short-term return on assets.
So they're essentially renovating the fortress while still living inside it.
That's a perfect way to put it.
But deploying 4.385 billion in capital expenditure in a single year requires immense liquidity. How are they funding this acceleration?
By optimizing their balance sheet. Historically, Almarai has operated with a somewhat conservative approach to debt, but they recognize the necessity of leveraging their strong credit rating to build the infrastructure for the next decade. Their net debt to EBITDA ratio currently sits at 2.48x.
Let's translate that metric really quickly. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a rough measure of companies' raw operational cash flow.
Right.
So a ratio of 2.48x means their total debt is almost 2.5 times the raw cash they generate in a single year.
Which I know sounds high to an individual managing household debt, but for a global infrastructure company, it is incredibly healthy. The board's optimal strategic limit for leverage is exactly 2.5x.
So they are floating right at their strategic ceiling by design.
Exactly. They aren't borrowing out of desperation. They're borrowing because debt is a tool to accelerate growth. The report actually mentions they issued a $500 million international sukuk to help fund this.
Yeah, I saw that. And a sukuk operates similarly to a traditional Western bond. But it is structured to comply with Islamic financial principles, often representing partial ownership in a tangible asset, rather than a pure debt obligation.
Correct.
What fascinated me about that sukuk issuance was the market response. They asked the market for $500 million, and the order book came back oversubscribed at $2.3 billion.
You go for 4 times what they asked for.
Right. Global fixed income investors looked at this dairy biosphere, evaluated the heavy capital expenditure, and essentially lined up around the block to lend the money. That suggests the institutional financial world has absolute confidence in the predictability of Almarai's long-term cash flow.
Because institutional investors do not throw billions at a leaking ship, the drop in short-term return metrics is recognized by the market as fuel being pumped into the engine for a massive expansion.
Which naturally leads us to the most exciting part of the report. If you were deploying 4.385 billion rials in a single year, what exactly are you buying? Where is the growth coming from?
The company frames this under a strategy they call growing within, expanding beyond.
Growing Within focuses on fortifying their existing dominant categories, primarily their monumental shift toward poultry.
And the poultry numbers are staggering. The report outlines an ongoing 7 billion rial capital investment cycle dedicated solely to poultry processing.
7 billion. That is massive. In 2025, they hit a record by processing 300 million birds. And they aren't stopping there. Their stated goal is to ramp that capacity up to 450 million birds by 2028.
That aggressive expansion is a direct response to a structural macroeconomic shift. Consumer diets across the region are moving heavily toward lean, healthy proteins.
Which aligns perfectly with national public health priorities in Saudi Arabia.
Exactly. The total domestic poultry market sits at roughly 1.6 million tons, and Almarai currently captures only about 14% of that total addressable market. The headroom for them to capture market share is vast.
I did notice a cautionary note in the report, though. They acknowledge that the current poultry market is highly contested. There's a temporary excess of supply, which is naturally tightening profit margins across the industry. Pumping $7 billion into a market that already has an oversupply feels risky.
It's a calculated war of attrition. Almarai possesses the balance sheet to survive a temporary margin squeeze, while smaller, less capitalized competitors fold under the pressure.
Freeze them out.
Yes. They believe the structural demand for healthy protein will vastly outpace this short-term supply glut. When the market inevitably consolidates, Almarai will have the infrastructure, specifically their new ultra-modern processing plant at the Al Jarrah site, ready to just dominate the landscape.
They're building the capacity for 2030, completely ignoring the noise of 2025. That covers the growing within mandate. But the expanding beyond strategy, their entry into adjacent categories, is where I started to genuinely question their focus.
Really? Why is that?
Well, in July 2025, they fully acquired Pure Beverages Industry Company for just over 1.04 billion rials. This gives them brands like Oscar and Ivel, pushing them heavily into the bottled water market.
Diversifying their beverage portfolio beyond dairy and juice is a logical defensive maneuver, though.
Conceptually, yes, it makes sense. But the report is surprisingly transparent about the financial reality of this acquisition. It openly admits that the water business is currently dilutive to their EBIT margin.
Right, it pulls down the average.
Let's simplify that for you listening. Bringing a bottled water company onto the books actively drags down the overall profitability percentage of the entire Almarai Biosphere. Bottled water is a notoriously low-margin, commoditized product. Are they risking their incredible 14% operating margin by straying too far from their highly profitable core competency?
Dilution is the classic terror of corporate expansion, but evaluating a strategic acquisition entirely on its year-one margin profile misses the point of the Biosphere model entirely.
Also,
These adjacencies, whether it's water, seafood, or red meat, are seeds for the next 5 years. You cannot buy an external water company and expect it to immediately replicate the profitability of a dairy network that has been relentlessly optimized for 50 years.
so the play is to annex a new neighborhood into the self-sustaining city and then slowly rebuild its infrastructure to match the rest.
Precisely. They acquire the water brand and then they plug it into their existing, hyper-efficient 12,000 truck distribution network. They apply their digital tracking systems, optimize the delivery routes, and use their massive purchasing power to lower the plastic packaging costs.
Over a 5 to 10-year horizon, they basically force the water margins to expand by subjecting them to the strict discipline of the Almarai ecosystem.
Exactly. You have to continuously find new categories to conquer if you want a 22 billion rial company to keep growing. But the counter-example to that massive water acquisition is their approach to the ice cream market, which I think demonstrates an entirely different approach to risk.
So the ice cream expansion is a masterclass in capital discipline.
It really is. With water, they dropped 1 billion rials to buy a company. With ice cream, they recognized that the cold chain logistics required to freeze and transport ice cream in a desert environment are brutally unforgiving.
Yeah, if you build a massive factory and the product flops, you have an unrecoverable sunk cost. So they didn't build a factory.
Nope. They utilized an import and co-manufacturing model to test the market first.
They designed the product to their strict specifications, qualified manufacturing sites outside the kingdom to actually make it, brought the finished product in, and just tested the waters. They forced the market to prove the demand existed before they poured the concrete.
And the market responded aggressively. That test run resulted in 70 million rials in revenue in 2025, which significantly outperformed their internal projections.
They proved their brand equity translated seamlessly to the frozen aisle.
Right. And only after the consumer validated the product did they open the checkbook. Now they're confidently deploying 500 million rials specifically to expand their freezer and chiller network. They de-risked the expansion entirely.
It highlights a real maturity in their capital allocation. They know that of all the new territories they are exploring, water, seafood, red meat, ice cream, perhaps only 2 will evolve into multi-billion rial core pillars over the next decade.
The others might remain profitable, but sort of niche adjacencies. By testing them methodically, either through co-manufacturing or strategic acquisitions, they severely limit their downside exposure while keeping the ceiling for potential growth limitless.
So what does this all mean? Stepping back and looking at this entire ecosystem, from the physical farms to the digital supply chain and through the balance sheet. Why does the margin spread and the capital expenditure cycle of a Middle Eastern dairy and poultry conglomerate actually matter to you listening to this right now?
It's a great question.
I think Almarai completely dismantles the prevailing wisdom of the modern tech era. We have been told for a decade that owning physical assets is a liability. Software eats the world, outsource your problems, build a platform, not a factory.
But Almarai proves that controlling the atoms, not just the digital bits, remains one of the most powerful competitive advantages on Earth.
Total, uncompromising control of a physical value chain, from planting the alfalfa seed in the dirt of South America to tracking the temperature of a delivery truck via the cloud in the Middle East, can be incredibly lucrative. The asset-heavy model isn't dead, it just requires an almost terrifying level of operational execution.
For anyone studying corporate strategy or supply chain dynamics, this 2025 report is basically a blueprint for enduring resilience, delivering 5% top-line growth and protecting massive profit margins during a year plagued by geopolitical shipping threats and severe commodity inflation. That is a monumental achievement.
It really is.
It demonstrates that when your foundation is built on owning the means of your own production, you don't just survive external macroeconomic shocks. You use your fortress to fund your next decade of expansion while your asset-light competitors scramble for suppliers.
It fundamentally changes how you look at that simple bottle of juice or carton of milk in your fridge. It is not just a beverage. It is the physical manifestation of a finely tuned, highly capitalized, fiercely protected global algorithm. Which leaves a lingering thought for you to consider today.
Oh, I'm curious.
If a food and beverage company can successfully run a tightly integrated, wildly profitable biosphere stretching across continents, proving that owning every single step of the process is the ultimate defense against global chaos, what other traditionally fragmented, heavily outsourced industries are ripe for this exact kind of extreme, vertically integrated disruption?
That is fascinating. If Almarai can achieve this level of dominance with milk and poultry, imagine what a company with similar discipline could do if they vertically integrated the housing materials market or the pharmaceutical supply chain or the clothing industry.
The fortress model works. The only question is, who has the capital and the sheer operational willpower to build the next one? Thank you for joining us on this deep dive into the biosphere of Almarai. We hope the next time you open your fridge, you see the massive logistical engine behind the simplicity. Keep diving deep.